Hello everybody. So as you can imagine, a critical week from a technical point of view with a lot of changes on a lot of markets. I will try to be brief as possible and not show you 100 charts. So we'll just focus on what's happening on the US stock market. Then we will make a quick update on what's happening on US bonds. And I will end with some technical comments on the Eurostock 50 and DAX 30. So if we start with a chart I showed you numerous times since last summer, this is the chart of the MSCI World ex-US, which is the orange line, and the white line is the MSCI USA. So strong outperformance between May and September of US versus the rest of the world. And what we saw very quickly in just a couple of days, a strong adjustment to the downside of US equities. So sooner or later, it was my insight, there must be a recorrelation between the two charts. So a recovery of world ex-US or a decline of the US. So now we have the answer. The bubble was on the US stock market, and the US stock market is starting to crash. Is it over? I'm not sure about that. If you look at the relative performance of USA versus the rest of the world, we are just seeing right now a short-term pullback, and I would favor a continuation of this adjustment with the US stock market probably underperforming again the rest of the world in coming weeks. If we now switch to the S&P 500, we can see that so far the correction looks very similar to what we saw in early February. As a reminder, in early February, the market declined by 10 to 11%. And right now we are seeing a decline of 6 to 7%, which is less than what we saw in February. So I think that the risk is to see a similar move, which means that the S&P 500 can easily go between 2600 and 2550. So 2600, 2550 is the next important support zone and a potential downside target for the current decline. If we now look at US bond yields, overbought signal last week for the second consecutive time. So this reminds me what happened in April, May. And given what's happening on equity markets, I think that there is a higher probability of now seeing a relief rally on US bonds with bond yields possibly moving back to 3%, which was the previously an important resistance and should now become a support. So I'm not convinced bond yield will drop below 3%, but it is highly likely now that we are going to see a relief rally, or at least bond yields calming down after recent tensions. If we end with some comments on European markets, so as you can see, a quite negative signal this week on the Eurostock 50 according to point and figure charts. A breakdown for the first time in 2 years below a major support line on point and figure, suggesting that the Eurostock 50 is likely to move lower, the next target being 3165. But after that, we have 3071, which is for me the real risk. So keep in mind 3071 if we continue to see weakness on the Eurostock 50 in coming weeks. Another quite important chart, that of the DAX. As you may remember, I started warning the formation of a major head and shoulder top on DAX very early when DAX was forming the second shoulder during the summer. So what I would like to highlight is that this head and shoulder is now validated, so a major head and shoulder top. The last time I noticed a similar head and shoulder top, major one, was in 2007, 2008. If you look at, for example, a technical outlook on CAC 40, major head and shoulder top, and it was a very good leading indicator of the subsequent bear market. So right now, what this head and shoulder top is telling me is that there is a high risk of seeing a mid to long-term bearish reversal on European stock market. So there is a new scenario appearing, and this scenario I also see it with Elliott waves. If you look from the low of 2009, there is a potential 1, 2, 3, 4, and possible wave 5 top at the start of this year completed, which means that DAX could be starting a medium to long-term bear market. So that's something new and something to keep in mind. Of course, it will not happen in 2 days. There will be some technical bounces, but I mean the longer-term picture is obviously deteriorating. I will end with a positive message. The positive message is that European stock market, after the sell-off of the last few days, is becoming oversold. 60% of Stoxx 600 stocks hit 3-month lows yesterday. This is a very good contrarian indicator I like a lot during sell-offs. As you can see, when we saw previous similar readings, low readings, usually it warns that a short squeeze is becoming more likely. So in the short term, beware of potential short squeezes. However, as you can see, it's not a good indication of major lows on the market. Sometimes it is, but not always. So at least beware of potential technical bounces in the short term, not necessarily major lows, but possible relief rallies. Thank you for your attention. Have a nice trading day and a good weekend.